The last 2 or 3 days, aside of what could be considered as concerns on the geopolitical front, which have probably waned a bit, I think there are concerns like emanating on our domestic front, predominantly with how the macro could be going towards a period of uncertainty and bit of worsening. What is your sense? Do you envisage that to be the case as well? And how would the markets react to such a scenario?
Well, what we need to kind of keep in mind and as a backdrop is that we've seen on one hand equity markets surge to new highs, because of which valuations have kind of gone on to the higher range from a historical perspective. Versus that, we're seeing basically GDP growth softening, and actually, so to say, that it's not yet started to accelerate in a significant manner. And so there are concerns emanating again that is it going to be now a few more quarters of wait for earnings to gather momentum. And as we step into a kind of a mega election period, 2018, 2019, will there be some kind of a let go which the government will have on the deficit side, the fiscal deficit side? Because there could be heightened spending and that could lead to a bit of a deterioration in the fiscal deficit and things of that kind. So I think on one hand, so far, the markets have been driven by liquidity and macros. Right. Sober inflation, strong, very good fiscal discipline. Now, is that kind of likely to kind of slip away a little over the next few quarters? I think that's a bit of the concern, but I'd probably say that the bigger concern right now is valuations. That I think is the bigger concern.
So if indeed valuation is a concern even in a good market with good macros, and if we are moving towards a period of slightly bad macros as well, for maybe no fault of ours, but what currency and what crude is doing, what the higher spending could lead to a fiscal slippage if at all, maybe the current account deficit worsening as well. Would there be a natural course correction to the tune of 5, 10 or whatever number you're working with, even though it may be healthy for the market, but could there be a natural course correction?
Oh, absolutely. I think that given the kind of up move that we have seen, a 5 to 10% correction in a bull market is kind of something which is kind of reasonably acceptable.
Are we in the midst of it already?
I think so. It looks like, and if you look at least till as of yesterday, I mean, we've seen, for example, the Sensex Nifty correct by about 3% odd. We've seen the mid-cap, small-cap space, the indices correct by 4 to 5%, and some of the stocks correcting by 5 to 10% already. So I think that is a process which has started. And if you really look at it, whether it was 2016, whether it is 2017, for some reason or the other, we've seen a 5 to 10% correction from the broad indices levels. And then again, we start to resume the fresh up move. And I don't think it's going to be any different now. What it looks like is that we could kind of go through both a price-wise correction of 5 to 10% in total, as well as some time-wise correction. So it's quite possible that we could be, for the rest of the calendar year, be in this range of this 5 to 10%. And then again, as the dust around GST settles down, as business gets back to normalcy and all of that, and if the government does come out with a stimulus or a propellant for the economy where growth comes back, then maybe 2018 could again be one more strong year for the markets.
So correction and then sideways for a while. That's your call actually on markets. But are there some pockets really in market where you would be extremely bearish because of the stretched valuations, where you think one should really stay away or sell if you are holding even with a slightly longer term perspective?
Well, what it looks like is that some of the really well celebrated stories, okay, around housing finance, around NBFCs, around some of the retailers, okay, I think some of this pack where valuations are, I wouldn't say they're just stretched, they're super stretched, okay, they're priced to perfection, that nothing can go wrong with them, right? So I think right now the way markets are pricing is that housing finance guys can commit no mistakes. Their asset quality is going to be completely spick and span, okay, no issues there. NBFCs, that every money that you're going to give to a truck operator or whatever it is going to be fine. You're going to recover every penny back. Okay, I think that's the way they're priced. Okay, retailers, I mean 50p multiple, 100p multiple. I think it's ridiculous, these valuations for some of these pockets. And I think again, so it comes back to my point early on, that in some of these pockets, I think there are exuberance. There is exuberance, and I think that's something which could, I probably think, the most vulnerable.
Interesting. Speaking about some of the pockets that we were discussing all morning as well, Pradeep. Retail, it's been in the thick of action. I know we're starting with the small micro right now, then we'll move on to the other larger indices as well. But it's an active pocket, and sell side seems to be finding no fault with an expensive company, or Amazon is finding no fault with a company which has had a terrible last couple of years and is hardly present in the online space as well. You think it's par for the course that we'll see some bit of moderation in the exuberant interest that we're seeing in the Indian retail space?
I would tend to believe so. I think, when we kind of look at any retailer, we say this is going to be India's Amazon, okay? But we really don't see what the kind of sustainable business model that Amazon has created over the last 10, 20 years, It took certain calls saying we were going to reinvest our cash flows back into business, create new verticals. So if you look at for Amazon, worldwide, it's not so much about retail. It's more about things like the Amazon Web Services and all of that, which are basically driving their own growth. That's the pocket which is actually now creating the cash flows for them, okay? And that's what it is. So I think it would be kind of, in a way, probably a mistake to kind of just believe that every retailer is going to be India's Amazon, or every retailer is going to get bought out by Amazon just because Amazon bought Whole Foods in the US for $13.5 billion. So I think some of these very simplistic kind of extrapolations, I think, are a bit illogical, irrational right now. But nevertheless, there is exuberance. So right now, be in the party and then decide when the music is going to stop.
So, okay, you can really say that you won't buy NBFC or private sector bank or some of the private finances because they are stretched, but you can't buy PSU banks either. You won't buy retail, but can you really go and buy pharma or IT or whichever sector is looking actually reasonably priced today?
Yeah, I clearly think so. I think the kind of valuations which are there on the IT side, I think the valuations are favorable. And it's not that these companies are going to kind of, close down. I mean, look at it. The IT companies are growing in single digit kind of growth rates. But then isn't the rest of the pack also in aggregate terms growing in single digit? Where is the earnings growth at a very high level, number one. Number two, valuations of the IT sector are at a cyclical low, in the sense you've not seen these companies trade at whatever mid-teens P multiples for many, many years, and that's exactly where they are. Third is maybe the currency could go favorable for them. Fourth is these are cash-rich companies. They're doing buybacks, right? See, look back at what happened with the US 5 years back. Those companies were doing buybacks, crazy amount of buybacks. And now you're seeing surge in their stock prices. Even the old economy guys, be it some hotel operators or retailers or whatever in the US, even their stock prices are doing extremely well. It's partly because of the kind of buybacks that they have done. So over a 2 to 3 year time frame, you would actually see some of the IT companies get back their business model, where some of the new age opportunities like AI and design thinking and all those kind of things, automation, become a reasonable part of their overall revenue kind of pie. Two is the impact on the balance sheet, the sense when they do buybacks, you're going to be putting cash to work, the ROEs are going to look better. And then third, of course, is that the valuations will catch up. So I think that looks a very, very interesting pocket. We also believe that over the next 1 or 2 years, you would see perceptible pickup in infrastructure spending. And clearly we believe that cement, which is right now kind of getting in a way clobbered, I think is a great area to be in. I think at these valuations, some of these cement companies look extremely good, purely again from valuations point of view. And over the next 2 or 3 years, that would, I think, be a great sector to be in.
It's interesting you say that. Yesterday we had a chat with a couple of cement companies, and so I know your call is long term, but I'm just saying that for the short term, they were saying that they are not seeing any kind of big demand pickup. And one interesting myth, at least it was my belief, which they busted, is that they mentioned there has been no drop in freight cost, nor there has been a substantial reduction in the timings for ferrying cement across the country. So I would have thought that with GST, or both of these would have happened, but that isn't happening. But coming back to, I don't know if you have a comment there, but...
No, I think we just need to wait for 2 or 3 quarters out there.
Okay, fine.
Okay, I think still 2 or 3 quarters could be sluggish. Okay,
got it.
See, this is the worst time for the cement guys. Okay, this from a season point of view. Okay, so this is honestly the wrong time to kind of even talk to them.
I got it.
Because they're going to be saying is that there is no volume of take, costs are high, all of that. But I think just wait for 1 or 2 quarters and then you will see again these guys. The big story in cement, I still think, is operating leverage. When you're operating at 70-75% capacity, you can actually grow your business by 40-50% over the next 3-4 years without having to spend a penny on capex.
That's true.
I think that's really where the big opportunity is as an investor.
But so regional or pan-India?
I think pick what you want, in the sense
What are
that
you
I
picking?
think
I mean,
I think
without getting into the
I think the
name.
regional local guys I think make sense, because at the end of it, cement is a regional or a local market. There are local dynamics which go into play. There are regional dynamics which go into play, and that's why valuations are also more attractive.
Okay, just a follow-up to Pradeep's question, and that is IT. Now, I knowing you, you don't bet on IT as a space, as a large theme that one size fits all. You pretty much go into the niche companies. I mean, the persistence of the NIT Techs of the world were something that you predicted first. Are you still bullish on those players, or are you betting on something entirely
No,
new?
we're bullish on that space. I think we're bullish on that space, and some of these companies which you alluded to have basically been focusing on the relatively new age opportunities. Opportunities like IoT, opportunities like SMAC, artificial intelligence, all of that put together. And what it looks like is that these kind of companies have invested in these opportunities. When I say invested, it's not about making some big bang capex, but basically taking a hit on their margins. So that basically they build up a critical mass, create this as a $100, $200, $300 million revenue pie, and then you're ready to accelerate once you've upped the learning curve. And I think that's what some of these companies have been doing, and I believe that that's the right thing for them to do. And the valuations right now, I think, make them really attractive.
Well, what market is really worried about right now is, rising crude prices. Do you think from $40 to $50, the range we saw for many quarters now, if we really move closer to 60, which is the current price, would that alter the earning expectation for several sectors meaningfully?
Oh, it would. I think the bigger damage that it would create would be twofold. One is it would definitely have inflationary pressures. There's really no doubt about it, and especially now, given that that price hike can kind of be passed on a daily basis. That's the new pricing environment. Okay, that's the right thing to do. So that's one. So it could create inflationary pressures, and two is it could kind of in a way restrict the fiscal space which the government has, which in turn could constrain any kind of a stimulus that it could be contemplating. So clearly believe that it will hurt the macros more rather than individual companies. Yes, there would be those one-off paint companies, etc., which would basically get impacted, or a lubricant company which could get impacted. But I see a bigger impact on the macros versus the micros.
That's interesting. By the way, speaking of crude, today's session, Aban offshore is up about 9% in trade. So some of these volatile stocks get clubbed out there. Just an ancillary out there, Nilesh, aviation. And getting clobbered the last 2 or 3 sessions, I think the expectation is that the ATF prices revision which will happen will be substantially higher. So all of these stocks are seeing a bit of a downtick. Any thoughts on that pocket? It's a micro pocket, but nevertheless.
Yeah, I mean, I still think one would want to revisit the age-old tenet that airlines don't create wealth. Okay, so that's an age-old tenet. You could kind of give various arguments to spin it the other way and all of that, but net-net it's a play on crude oil. Okay, if crude oil falls, that's the place to be in. If crude oil rises, that's the place to exit. That is it. I don't think the operating matrices have changed dramatically. Okay, because there's no real USP of any individual player. The ability of the other player to basically just catch on to any of the virtue which the other airline is creating, I think is very immediate. So you could say one airline is operating on negative working capital, but yes, everybody else is operating on negative working capital. Somebody really says dynamic pricing, within a week the other airline just kind of adopts dynamic pricing. So I think the bigger challenge for them is that I still think India is a price sensitive market. Let's not compare ourselves with US or China, which are got multiple times our per capita GDP. So you have pressure on pricing, and the ability to hike prices, okay, which means fair realization, even when you're operating on very high occupancy or very high load factor, I still think is very restricted. So I'd say that if crude is kind of on its way up, this is not the place to be in.
Certainly seems to be the case. Pradeep has been speaking about it for the last few days. But Nilesh, take a moment to thank you for joining in today and giving us your thoughts.
Thank you, Neeraj.
And look forward to have you more often on our forum.
Thank you, and all the best.
Thank you.